Welcome back. You're watching Your World at 10. Now, the big debate this week has been that over currency wars. And in the matrix of what's happening between the US and China, the capital controls imposed by Brazil and Thailand and being considered by a whole host of other emerging markets, there's the question of what the Reserve Bank of India and the government should do or ought to do about the flood of capital, if it is indeed a flood, into India and the rise in the rupee. Well, joining us to discuss that is Dr. C Rangarajan, the chairman of the Prime Minister's Economic Advisory Council and, of course, former Governor of the Reserve Bank of India. Dr. Rangarajan, thank you very much for your time this evening and thank you for joining us on Your World at 10. So let me ask you first, with regards to the external environment, what several people are calling the potential of a currency war breaking down or breaking out, a race to the bottom. How destabilizing do you anticipate this could be to the global growth situation and what implications could it have for India?
If there is all-out currency war, it will be very damaging to the world economy. The growth process, which is still very slow in the developed economies, will be severely affected, and it will also affect the developing economies. But one only hopes that it will not blow into emerge into a full-scale currency war.
So this is quite obviously going to be the focus of talks in the upcoming G20 meet. The US-China debate aside, several emerging nations have, have either imposed some form of capital control or are considering some form of capital control. You've had what's going on in Brazil, in Thailand. Analysts are expecting Taiwan, Korea, and maybe even Indonesia to start looking at some form of capital controls. How do you assess the chances of a currency war breaking out? Of course, if it breaks out, like you pointed out, it would be disastrous. But what are the chances currently in your assessment of such a thing happening?
I think some compromise will be worked out at the G20 meetings. Neither United States nor China would be interested in pushing this to the brink. I don't particularly think that the possibility of a full-fledged war, currency war, bursting on the world economy. I think as far as the capital controls are concerned, that is based on a different set of consideration. I think the emerging markets feel that possibly because of the liquidity available in the world system, there will be more influx of funds into the countries, and they are keen and anxious to limit these inflows or to ensure that the impact of these inflows is not too much on the economy.
Dr. Rangarajan, let me come to the India view then, and let's start first with the rupee as well as the intervention issue before I actually, in fact, go into the capital controls point of view. We've seen about a 5% appreciation on the rupee this year. It's at mid-44 levels. We've seen one bout of intervention by the RBI last week. What rupee level are you building into your assessment? Where do you think the exchange rate is likely to go and settle, or over the short term at least, considering that the flood of liquidity coming in from some of the developed nations is unlikely to be stemmed in any fashion?
Well, as far as the appreciation of the rupee is concerned, it is very much in relation to the dollar. In relation to the other currencies, it has been a zigzag. I mean, it is not in one direction. On the whole, I think that the trade deficit has a tendency to widen. And therefore, in this particular context, we need to ensure that the rupee, in terms of the dollar, does not appreciate in nominal terms. Perhaps we should stay more or less at the same level that we had at the beginning of the fiscal year. Therefore, the first step is really to ensure that the rupee does not appreciate in nominal terms. In real effective terms, of course, the rupee has appreciated. That is precisely because of the high level of inflation in this country. Only when inflation in India comes down very substantially, the real effective exchange rate appreciation can be stopped. But in nominal terms, I would suggest that the RBI should take such action as may be necessary to ensure that it does not appreciate.
So what is that such action? Is it more direct intervention that you're referring to?
No, I'm not. I'm talking in terms, yes, if the capital inflows are very large, then I think the Reserve Bank of India should be willing to intervene in the market and accumulate the reserves. But let us also understand that until the end of August, the capital inflows into India was not really that strong. the addition to the foreign exchange reserves until the end of August was very minimal. The surge is seen only in September and in October. But also let us look at the capital inflows in the context of a widening current account deficit. Perhaps the current account deficit of India in this year will be close to 3% of the GDP. This will be equivalent to something like $45 billion, and therefore we need capital inflows to finance the current account deficit of that particular order. And some addition to the foreign exchange reserves over and above the covering the current account deficit will also be needed. There is still some scope for the Reserve Bank of India to absorb the capital flows into the reserves.
So, Dr. Rangarajan, in fact, that is the view that most economists hold on the street as well, that we have to draw the distinction of India's current account deficit situation with regards to maybe talking about India in the context of capital control, so to speak, and that's exactly the point that you're making. Do I therefore draw the conclusion that you're not very concerned or worried about the quality of flows that's coming into the country? You pointed out that a large amount of it has come in only after August. We've had about $10 billion come in, and maybe even more, in terms of portfolio flows since then. FDI through the calendar year to date has been about $12 billion, but totally we're looking at about $22 to $23 billion of portfolio flows and about $12 billion of FDI flows. How do you assess the quality of these flows, and if they continue in this fashion, at what point should we start talking capital controls of some form?
As I mentioned earlier, that we can wait and see how the capital flows are going to move in the coming months. There is scope for capital flows of the order of about $50 to $60 billion into the country, which will cover the current account deficit of about $45 billion and add to the reserves of something like $20 billion or $25 billion. Until that particular point, I think we should not really worry about the capital inflows. That is the order of magnitude in terms of the capital flows that I'm talking about. Some $60 to $70 billion of capital inflows into the country we should be able to manage.
So in that case, it would be premature to talk about any form of capital controls, and I don't only mean something as draconian or onerous as a Tobin tax, but in fact we've used several measures in the past. We have a wide range of ammunition on the table, whether it is tightening the ECB window or even doing something with effects to participatory notes or going all the way to Tobin tax. It's too premature to be talking about any of this right now, at least.
I think the time has not come to think in terms of controls over the capital flows. But as you know, that there are many other controls that are operating in a subdued way. For example, as far as external commercial borrowings are concerned, above a particular limit, a prior permission is required, and we have always operated with some kind of a informal ceiling on external commercial borrowing, so that can be activated. Then even in respect to foreign direct investment, if there is a large amount of investment going into what may be called speculative areas like real estate, there is also a mechanism to act. And in the case of NRI deposits, there is always the interest rate mechanism that we can make use of to contain if there is a large inflow. Therefore, there are many measures that are available to us in order to contain the inflows of capital into the country. We need to think about them if, as and when the capital inflows, in my view, exceed something like $60 to $70 billion.
So when you look at the money coming into the stock markets, we're at multi-year highs in the stock markets. Now, of course, experts will point out that we're currently trading at maybe 15 times in terms of multiple, as opposed to the highs of 2007, which were about at 21 times. But does the flow of money coming into the stock markets concern you in any fashion with regards to the potential building up of asset bubbles? Yes,
it is a concern that if the stock prices rise highly disproportionate to the fundamentals, it's a matter for concern. But what is also happening is that there are many initial public offerings coming into the market. Now, if the FII inflows, portfolio inflows, go into subscribing to these public offerings, then it may not produce a kind of asset bubble or the bubble in prices.
Can I move now to the issue of inflation? So you were quoted recently as saying inflation is at an uncomfortably high level, so continued actions on the part of RBI may be needed, perhaps one more round of tightening. Do you still hold that position in the face of A, the IIP numbers, B, the fact that credit growth has been considerably low? Do you still believe that there needs to be maybe one more round of tightening?
Well, I think the Reserve Bank of India has been following a policy of small steps. I mean, it has not made a very sharp increases at any point in time. Still, since the inflation rate still remains at 8.5%, I believe continued action on the part of the RBI may be necessary. Once we see a distinct trend for the WPI inflation to come down, perhaps that may be the time at which the Reserve Bank of India may stop further increases.
All right, Dr. Rangarajan, thank you very much for joining us on Your World at 10 and sharing your perspective with us. That was Dr. Rangarajan, the Chairman of the Prime Minister's Economic Advisory Council. With that, we're wrapping up this edition of Your World at 10. Thank you very much for